Welcome back, everyone. If you're here, you're probably looking to step up your investing game. Analyzing stocks can seem daunting, but today, we're going to break it down into 5 key metrics that will help you analyze stocks like a pro. Whether you're a beginner or someone looking to refine your strategy, this video is for you. Section 1. Price to earnings ratio. Let's kick things off with one of the most well-known metrics, the price to earnings ratio. The price to earnings ratio is calculated by dividing the current share price by the company's earnings per share, EPS. So why is the price to earnings ratio important? It helps investors determine if a stock is overvalued or undervalued compared to its earnings. A high price to earnings ratio might indicate that the stock is overvalued, while a low price to earnings ratio could suggest it's undervalued. However, it's essential to compare the price to earnings ratio with other companies in the same industry to get a more accurate picture. Section 2. Price to book ratio. Next up is the price to book ratio. This metric compares a company's market value to its book value. The book value is essentially the company's assets minus its liabilities. A price to book ratio below 1.0 typically suggests that the stock is undervalued, while a ratio above 1.0 might indicate that it's overvalued. The price to book ratio is particularly useful for analyzing companies with significant tangible assets, like manufacturing firms or banks. Section 3. Dividend yield. For those who love getting some cash back, the dividend yield is a crucial metric. The dividend yield is calculated by dividing the annual dividend per share by the stock's current price. A higher dividend yield can be attractive, especially for income-focused investors. But beware, a very high yield might indicate that the company is in trouble and trying to attract investors. Always check if the dividend is sustainable by looking at the payout ratio and the company's overall financial health. Section 4. Return on equity, ROE. Now let's talk about return on equity, or ROE. ROE measures a company's profitability by showing how much profit it generates with the money shareholders have invested. It's calculated by dividing net income by shareholder equity. A high ROE indicates that a company is efficiently generating profits from its equity base, which is a good sign for investors. However, it's essential to compare ROE with industry peers to ensure the company is truly outperforming. Section 5. Debt to equity ratio. Last but certainly not least is the debt to equity ratio. This metric compares a company's total debt to its shareholder equity and gives you insight into the company's financial leverage. A high debt to equity ratio means the company is heavily financed by debt, which could be risky if earnings don't cover interest payments. Conversely, a low debt to equity ratio suggests the company is using less debt to finance its operations, which could be a safer bet in uncertain markets. And there you have it, the 5 key metrics: price to earnings ratio, price to book ratio, dividend yield, ROE, and debt to equity ratio are essential tools for analyzing stocks like a pro. Remember, no single metric should make or break your investment decision. Always look at the bigger picture. If you found this video helpful, don't forget to hit the like button and subscribe for more tips on mastering the stock market. And as always, drop your questions or thoughts in the comments below. We'd love hearing from you. Thanks for watching and happy investing.